The topic of the day is the new tax law, and frankly, it's not that new anymore. There's an added element to this talk that is brand new. It's called the Secure Act, and they just passed it in December. And when I say they, I mean Congress. Miraculously, frankly, because it passed almost unanimously in the House in the summer of last year, and then it sat as a bill just sort of in frozen mode for about 6 months, and then all of a sudden, miraculously, it was presented as a bill to vote on, and it passed the Senate very easily and was signed by the president. So the fact is that Democrats and Republicans clearly can work together when it comes to tax law and also changes in retirement rules. And so that's what really the Secure Act is all about. And it has implications on a couple of things when it comes to taxes and your IRA and the requirements you have as you get older, and also inheritances of IRA type money. So I want to kind of make sure we talk about that at the very end because it is the new element. But the core of this talk is not going to be about a new tax law. It's going to be about the tax law that was put into effect at the beginning of 2018 and has now been in place for 2 full calendar years. And we're entering now the third calendar year of this tax law. So I'm going to go through some of the main highlights of this tax law and how it has an impact, I think, in terms of your tax planning, your habits when it comes to gathering tax information. And then I'll have a few things that I want to kind of highlight that are important for you to remember in terms of saving taxes, for example. But what's a new element of this talk is I kind of am going to talk a little bit big picture about the state of things from a government fiscal perspective, because I find it interesting, especially in my line of work, managing money for people at different points in what I would describe as an economic cycle. We're dealing now, we're about 12 years into a recovery, 11, 12 years into a recovery, and from the very big decline in 07 to 09. And we're running trillion-dollar deficits currently. For as far as the eye can see, this is a snapshot of really what last year looked like, 2019, about $1 trillion, and you can see that 2020, the projected deficit is around $1 trillion. I think we've built up over $22 trillion worth of debt. So these deficits are the annual figure. The debt, of course, is the cumulative figure. And it's an interesting thing to be doing 11 years into a recovery. Typically speaking, you run deficits at the point where you have a recession. And that happens naturally, and it also is kind of on purpose to help lessen the blow of a recession. So you can remember back in the 07, 08, 09 timeframe, deficits ballooned. That was done through stimulus spending, but some automatic things happened that actually cost the government money on the expenditure side. For example, unemployment benefits begin to balloon, and it's built into the code, built into the system that you would actually have unemployment benefits rise while people are becoming unemployed, and that buffers the downturn in the economy. But you also do things like stimulus packages. And we had a very large one that kind of spread around the entire economy. Critiques of how they did it, are always going to happen, but they spent a lot of money to sort of create that demand from the government level while the private demand was diminishing. So it was very natural, but then as you grow, your deficits begin to shrink because your revenues begin to pick up. Tax revenues begin to pick up because people have jobs, they're making money, there are gains. There's a lot of things that happen along the way that creates revenue. So that helps to decrease the deficits during the boom time. But what's interesting about this situation is we actually have deficits growing at the tail end, if you want to call it the tail end of a recovery. We're having growing deficits with an expectation, and this is an interesting chart because what we have here is 2 sets of projections. one from the Congressional Budget Office, which is really a nonpartisan analysis group that Congress has agreed to use to analyze the future. And they're comparing the deficit projections according to the executive branch, which would be the White House. And so you've got a situation where there are a set of assumptions that are clearly differing. I personally think that the data that we're seeing in this darker area, showing the deficits that are right around $1 trillion or more, and moving that forward $1 trillion a year for potentially the next 10 years is probably more likely the case. The expectations of growth in the economy and therefore a diminishing deficit picture, while it may come to pass, it's banking on a lot of good things happening. We're already 11 years into a recovery. I'm not predicting necessarily a recession in the near term or frankly in the next 6 to 9 to 12 months. It's very difficult for anyone to predict that. But I think I can safely predict that we're going to have a downturn to some extent within the next 10 years because that's the way the world works, typically speaking. So if you think about it, during the next recession, the spending side of it will increase naturally because that's what governments do to try to buffer the blow. And we might not necessarily be in a position where that's going to be affordable given the fact that we're already running trillion-dollar deficits. So this tax law had the impact of exacerbating the deficit picture in the near term. I think the theory is that this tax law is going to spur the economy in the intermediate term, which will then create a situation of lower and lower deficits as the economy grows. And that's still an untold story. We don't know the answer to that, and we'll see it over the course of time. So I'm going to go through a few slides of some major shifts and changes in the tax code that happened really in the beginning of 2018. And I put some red bars around some areas that I think are of a special interest. Prior to the current tax law, which is the Tax Cut and Jobs Act, that's what TCJA means, and that's what they called this tax cut. You can see that tax brackets for single filers and for married filing jointly changed. The biggest changes occurred, I would say generally speaking, for lower income people. The 10% bracket was relatively the same. Then the 15% bracket became the 12% bracket. So there was a nice 3% decrease right off the bat for lower income. And I say lower income, it's where the majority of Americans sit. So it's probably not fair to say lower income. I could say really the middle income. You'd see a 3% decrease in the income tax rate at the federal level, and that's the same on the single side as it is on the married filing jointly. 15% is the old rate, 12% is the new rate. And you can see then as you move up another bracket, the same 3% differential is maintained, a 3% decrease in tax rates. What's interesting is there are certain spots where the tax break was bigger than 3% for certain income levels. On the single side, there used to be a 28% bracket. Now it's 24, so it's 4% lower. And as you get out to people who are at the very highest income levels, taxes used to be at 39.6. They've been shoved down to 37%. So the cuts, the tax cuts were probably the biggest impact was in this group that, for let's say, example, married filing jointly would be making somewhere in the range of $150,000 to $400,000. So those are pretty well-to-do couples. They received the biggest tax break, frankly, from a percentage perspective. And that's just the way that it worked out for that group. And then I would say consistently between single and married, those with the very highest income received a big tax break. And I will tell you there, and I think I've got a chart on this, it's a disproportionate amount of the tax breaks, the benefits of this tax cut, went to the higher income brackets. Part of that, I will say, is related to the fact that higher income cohorts of people pay a huge amount of the tax. So you're, of course, going to have a tax code where the people who are making the most are also going to receive the biggest benefit from a tax cut. But it's one of the critiques of this plan is that it really benefited the wealthy to a very large degree relative to lower and middle income earners. So that is the first big change, is that you can essentially see that the tax rate decreased by about 3% across the board. I'm just going to use that as a general statement. And that's a pretty big reduction. The second change is how we deal with deductions and personal exemptions. So now that it's been 2 full tax years, 2018, 2019, I think people can start to forget about what the old tax code felt like. But you've all been around long enough to remember this idea of personal exemptions. Just simply getting a deduction off of your taxable income because you're a living, breathing human being. And depending on if you had children that live in your home, they also counted as living human beings that you were able to take a personal exemption against. That whole concept of a personal exemption, which used to be about $4,000 per person, that's just gone. It doesn't exist anymore. There's no such thing as a personal exemption on the federal tax code. And so what they did in response to that is they said, well, geez, we're taking away pretty big deductions. We're going to instead just double the standard deduction. So as a taxpayer, you get a standard deduction. A single person gets around $12,000 or so. It's a little bit bigger now. I think it's $12,400. And a couple gets about twice that. So over $24,000 is a standard deduction. And your job as a taxpayer is to say, do I take the standard deduction or do I look at my itemized deductions, things that are listed out, and decide if I want to itemize my deductions, if that's beneficial, or just go with the standard deduction. So itemized deduction, that's a comparison you have to make. The itemized deductions are made up of 4 main categories. Mortgage interest. And nothing really changed in a real fundamental way with this tax code regarding mortgage interest. Some things did change. There are limitations on how much of a loan you can have and still deduct the interest. There are limitations on the combination of your primary home and a second home that, that debt can't add up to more than a certain dollar amount. And they made some adjustments to that, but by and large, that mortgage interest stayed about the same. The mortgage interest deduction stayed about the same. In addition to that, you have things like unreimbursed medical expenses. So this can be anything that's really out-of-pocket medical expenses. And it has a special threshold where you can't deduct those expenses under that threshold, but any dollar amount that's over a certain threshold, you can. And let me just describe that threshold for you, that idea. Imagine that you had adjusted gross income, like all your income was $100,000. The government says that, okay, 7.5% of that $100,000, so that's $7,500. The first $7,500 of your medical expenses, you don't get a deduction for that. But if you have expenses beyond that $7,500, that'll be deductible. And I crossed off the percentage on the screen saying 10% because this is what it was going to look like in 2020. They just passed with that same Secure Act bill that was all lumped into a much larger spending bill. They decided to make it 7.5% again, which is what it's been for quite a while, 7.5%. So you can see them reducing that threshold helps people who have medical expenses. A good example of when this really, really matters is, and it's a sad circumstance, but oftentimes at the end of a person's life, they may go into a nursing home situation or a long-term care situation where they have extraordinary medical expenses at the end of their life or the last few years of their life. And that this is an opportunity to have those expenses show up as an itemized deduction, giving them some tax benefit. So if you ever have anybody in your life that's going through that, it's probably not the right time to talk about it, but make sure that they are aware of the fact that those expenses that they're incurring can have a tax benefit for them. And it happens to people that I know quite often. So that's the second category, unreimbursed medical expenses, and it comes with that threshold. So you have to think about that threshold. So you may actually have medical expenses, but you don't have enough of them to cross over the threshold. If you make a lot of money, the threshold's much higher, so you're not going to have it unreimbursed medical expenses to itemize. If your income is lower, your threshold is lower, and therefore you might. The next category are state and local taxes, and we're talking about property taxes and state income taxes. There was a major change. The tax law prior to the tax cut that started in 2018, there was no limitation on how much property tax and state income tax was deductible. And they capped that out at $10,000. And so for a number of people in a number of states, and I don't think I'm going to cry for them. They probably have a couple homes. They live in a high tax state. They live on the water. I mean, there's a lot of things that you go, well, these are not things that, well, as they say, it's a first world problem. But the fact is that they put a cap on it. And so that did have an impact on the level of itemized deductions that a person could possibly have if they had a very high value property with high property taxes, and also made a lot of money and paid a lot of state income tax. So they put a limitation on that. And then lastly, there are charitable donations. And charitable donations are still deductible if you're itemizing. If you're not itemizing, it means that you're filing with a standard deduction. The standard deduction was doubled. So the bottom line of all of this was that somewhere in the range of about 30 to 35% of all people were itemizing before the tax cut. After this change, where they upped the standard deduction and they hobbled the itemized deductions, it created a situation where somewhere in the range of about 10% of taxpayers are actually itemizing, and 90% of them are using the standard deduction. So in this room, does anyone know if they're itemizing or using standard deductions? So give me a little show of hands of who is itemizing. Yeah, and then standard deductions, probably the vast majority of people. And this is kind of reflective of the actual society. So it definitely, the tax code became simpler. And the reason it became simpler is that we used to have to add up all these things, get all of the different forms, track all of your expenses, look at all your charitable donations, add them all up, present them to your tax preparer or do it yourself. And you had to do it because the standard deduction was much smaller. Now with the doubling of the standard deduction, everything got simpler in terms of record keeping. But you missed out now on the opportunity to actually get a tax break for donating money to a charity. And part of this talk is going to be talking to you about some of the opportunities that exist for regaining that ability to deduct, or essentially deduct, charitable donations. And I tend to talk about that quite often. So the third slide is going to show you just a few quick changes that are in addition to the things that I previously pointed out, the tax rate and the change in the standard deduction. In addition to that, the estate tax was, the thresholds for applying an estate tax was doubled to somewhere around $22 million for a couple, 11 million or so for an individual. So it took the estate tax conversation and pretty much threw it out the window because the vast majority of households are well below the $22 million limit. The alternative minimum tax, and some of you may be familiar with this, it was a tax code that was running parallel to the regular tax code for the last 50 years, invented somewhere around 1969, and it was designed to make sure that the super wealthy, there was something like, I'm going to throw out a number and I'll be wrong, but it was like 5,000 households were so savvy with their taxes that they were able to avoid paying income tax under the normal tax code. And Congress said, well, this, of course, is completely unacceptable. We're going to tell them there's going to be an alternative minimum tax that people have to pay based on a completely different set of calculations, because we've got to make sure that those 5,000 households pay their fair share. And so that alternative minimum tax code was running parallel for the last 50 years. Interestingly, the way in which it was designed was slowly capturing more and more and more households into the alternative minimum tax world. So the AMT applied to not 5,000, not 10,000. It kept growing and growing and growing and growing. And it did it through a very sneaky method. It was called inflation. So the tax code wasn't adjusting for inflation's effects, that alternative minimum tax code, and it was slowly enveloping more and more families, more and more households, more and more taxpayers. And every year, the Congress had to make last-minute, end-of-year kind of adjustments to take the AMT off the table for some. So it became this very political football at the end of every single tax year. Were they going to pass the fix-it for the AMT? And invariably they would do it, but it was a pain, and it was expensive for some taxpayers who were never the original targets of the AMT. Well, this AMT still exists technically. But for all intents and purposes, when you look at the design of the thresholds now, it doesn't affect anybody practically. So it's pretty much off the table. The AMT was eliminated, although it still exists. Just doesn't capture many people at all. The last one is actually, so I just gave you two examples of changes that really affect a sliver of society. So you all can have a collective eye roll on that, because who really cares, right? It might affect some of you, but I'm not going to ask you to raise your hand, okay? So, but the third one affects more people. It's this child tax credit concept. And this one was super interesting just from a legislative perspective, because it makes zero sense to me. I think it was Marco Rubio in Florida pushed for this. And if any of you remember the tax bill going through, the negotiations that were ongoing, it came down to the Senate, and there were like 2 or 3 senators that had the ability to kill the entire bill, because you had to get 51 votes. So it came down to a few senators who kind of played the straddling the fence game and were just waiting around for little sweeteners to get put in the bill for them to vote yes. And Marco Rubio keyed off of this one. He took the child tax credit that used to be $1,000 for every kid under the age of 17. So, let's say it's a joint, married filing jointly, a couple with a child under 17. You get a $1,000 tax credit under the old code. But you couldn't make too much and get that tax credit. In fact, it started to phase out for a married couple at about $110,000 of adjusted gross income, and it would phase out completely as they got to like 140 or 150,000. So once you made 150,000, of course, you don't get a tax credit for having a kid. Well, Marco Rubio was able to negotiate a doubling of the tax credit to $2,000 per kid. So that's exciting for those people that have children. And in addition to that, he took the phase out on the income, and he took it to $400,000, where it begins to phase out. So enveloping a huge pile of, I shouldn't say a huge pile, enveloping a group of people who are very well off from an income standpoint. They receive a $2,000 per kid tax credit, which if you think about it, that's awfully phenomenal, because it really is sort of flies in the face of all logic, in my opinion, that you'd provide a tax credit for having a kid for 2 lawyers making $398,000. Or a physician, I don't care who it is, but $400,000 is a lot of money, and you're getting a tax credit from the government. So it kind of shocked me. In addition to that, if you, in the old code, well, I should just say in both codes, if you don't even pay enough in taxes where the credit, you don't need a credit because you don't pay enough in taxes, or you have a zero tax bill, the credit actually is partially refundable, meaning refundable basically means that even if you don't have a tax liability, we're going to give you a check for $1,400 per kid, and we'll just send it out to you. So even if your tax bill is zero, you still have kids, we'll send you a check for $1,400. So there are people who have zero tax liability who then get a child tax credit in a refundable form where they actually send you a check. Now, I'm not going to complain a lot about that, because I'm in a circumstance in my life where I actually pay taxes, which means I have income, which is a good position to be in. If I were in a position where I didn't pay any taxes at all and I had kids, it means my income is awfully low, and getting a check probably is the difference between clothing them and feeding them. So, but the fact is that became a refundable credit of $1,400, and that was Marco Rubio. So that was a major shift, a major change. And it really did impact lower income people. In addition to getting a tax cut in terms of their rate, now they're also receiving a bigger child tax credit. So let me talk to you about a major thing that's looming that I think will ultimately be taken care of. Just because this is the way the legislative process works, you usually inch your way towards the cliff, some looming deadline, and then they figure out what to do. They very often don't just fall off the cliff. But they get awfully close to the cliff, because that's human nature, to delay the tough political things that they're required to do. So this tax law, everything that I just mentioned to you, is related to households. And almost all of those changes are going to sunset in 2025. So they were only put in place for a certain window of time, after which everything snaps back to the old tax law. So all those tax breaks will disappear. Everything will go back to the way it was. They did this once before in my recent memory, where George Bush, he put in a tax cut somewhere around 2004 or 5, something in that time frame, and everything was going to sunset in 2011 or 12. And by the time we got to 2011 or 12, President Obama negotiated with Congress to extend many of the elements that had existed prior to that. But it took all the way to the very end of the sunset period for that negotiation to happen. I expect the same thing will happen. Interestingly, you can see in 2019, this is a breakdown of people who make less than $10,000, 20 to 30,000, 30 to 40,000, 40 to 50,000, 50 to 75,000, all the way up to people who make over $1 million a year. The tax break varied by different income levels according to this analysis, where percentage-wise, some of the people making 200 to 500,000, it was a very, very big tax cut, close to a 10% decrease. But the biggest one was for people who were totally in the lowest income area. Dollar amount, folks, is way different than percentages. So when you're making $300,000 and you're getting a very big percentage tax cut, it translates into huge dollars. People who make very little, it may look like a large percentage tax cut, but it's only a few $100s. But interestingly, if you get to the sunset situation and the lemmings fall off the cliff, the biggest damage will be done to those who make the least. And I think part of it is the child tax credit is probably a big element of that. When that disappears, those refundable checks will no longer happen, and it will really impact the lowest income in society. They're not going to necessarily let this happen, but I can guarantee you they're going to get awfully close. And I guess it depends on the election or the elections along the way. Really, there's one more election, 2024. So frankly, they're probably all going to wait around to 2024 before they even start thinking about 2025. And that election will be key as to what happens here. And even if there's a change in party in 2024, I think they'll do what President Obama did, which is you pragmatically negotiate with the tax code that you have because you don't want to be the one residing over a large tax increase. They did all of that sunsetting because of a legislative trick. The legislative trick was you can't pass a bill without a supermajority, a tax bill, without a supermajority and have it be permanent if your projections out 10 years create deficits. So what they did is they said, okay, we know that what we're doing will create deficits 10 years out, and we don't have enough votes to make this a supermajority, so we're just going to pass it with 51 votes, and we're going to make the deficits disappear by just having the whole bill just go away in 6 years. What did they keep as permanent? Corporate taxes went from 35% to 21%, and that was a permanent tax cut. The estate tax threshold of $22 million, that does not go back down to what it was, which was $11 million per person. $11 million for a couple versus 22. That does not disappear. So they kept certain things as permanent, and they decided to make these things temporary for legislative reasons. They had to pass the bill. They only had a certain number of votes, and this is how they chose to do it. And they kicked the can down the road for someone else to figure out how to negotiate. So I'm going to now talk to you about some ideas, some thoughts for saving taxes and working around the new code. So the biggest thing I'm going to focus on is this charitable contribution aspect. Charitable contributions, as we kind of went through, are part of your itemized deduction list. But if you're a standard deduction person, you don't really care if you gave $1,000 to the church or $500 to Father Fred. It won't be deductible if you wrote a check from your checkbook. You'll hand that list of donations to your accountant, and your accountant will say, that's great, thank you for keeping track of all of that, but your standard deduction is $24,000. And incidentally, I didn't say it, but it's important to say, for people over the age of 65, they give you a little additional part of the standard deduction. So really, for a married couple, both over 65, it's closer to $27,000, not $24,000. They give you an additional $1,300 per person. So $27,000 for a couple that's over the age of 65, he'll say, thank you so much. He or she will say, thank you so much for doing this data and giving me the property tax bill and all the donations you gave. But all of that was a waste of your time because $27,000 is bigger than anything you just gave me on that list. So you didn't really get any tax benefit for having made the donation. You got many other benefits for doing it, like maybe you actually care about the charity that you're donating to and you like the stuff that they do for those people. And to keep that in mind, you don't let the tax tail wag the dog, but there is a way to actually regain the deductibility of your donations by using your IRA as a charitable vehicle. And they're called qualified charitable distributions out of your IRA. So everybody who is under the age of 70 and a half, you can shut your ears because it doesn't apply to you yet. Everyone over the age of 70 and a half, it totally applies to you if you have an IRA. And I'll also say, keep your ears open if you actually have charitable intent. If you're over the age of 70 and a half and you have an IRA, and I add the third thing on that you have no interest in giving money to charity, then this is totally a boring topic that has no relevancy in your life. So I'm going to assume that the people I'm talking to have some level of charitable intent, and I don't really care what dollar amount that is. Any dollar amount matters because you can save taxes by using your IRA as a charitable vehicle. through what's called qualified charitable distributions. I'm going to introduce this concept with one more piece of information because it matters in how much of a tax break your charitable donation's actually going to provide you. Your Social Security can be taxed, up to 85% of it can be taxed. But doesn't just happen automatically. The government first looks at all of your income. It's actually a very special calculation. It's called provisional income. And it's basically all of your income, ordinary income, dividend. Ordinary income is things like interest, on CDs or interest on bonds, dividends and capital gains. So all your investment income counts towards this provisional income idea. And also municipal bond income counts. So they want to know, even if you've put money into muni bonds and you don't pay income tax on it, it still counts as income in this provisional income concept. In addition to that, they say, now I want you to also tack on to this income figure half of your Social Security benefit. So keep this all in mind. Half your Social Security benefit plus all of your investment income and municipal bond income. And things like rent. If you're renting out, you have a rental property, that counts. Business interests, that counts. I mean, we're talking about all your income plus half your Social Security. It's provisional income. And the government basically says that we're going to look at that provisional income and we're going to decide whether you've got too little or too much provisional income. And if you have more income than the typical person, more and more and more of your Social Security will get taxed. If you have less income, less and less and less of your Social Security will be taxed. In fact, it could very well be zero. So there's this scale of your income that actually moves your Social Security from not being taxed at all to being 85% taxed. Okay? So they're looking at your overall wealth in terms of income, and they're deciding, well, maybe we'll actually tax some of that Social Security benefit that we give you. This is something that was introduced in 1983, and it was designed to bring in revenue for the Social Security system because it was underfunded, and they had a projection of it being, a very bad outcome. And so they said, we got to figure out how to fix the system. So they said, well, we need to get more revenue. This was one way. They also increased your payroll taxes. That's another way. And they said, also, you can't get your benefits as early. We're going to make it so that you have to be 67 someday, not 66. So they put in these birth years and said, you're like me. I'm 67 is my normal full retirement age. People, I can't remember the actual cutoff, but it was 1954, I think, was when it started moving from 66 up to 67 year by year by year as your birth age, your birth year increased. So they did some things to say, hey, we're going to get revenue and we're going to also decrease the benefit. This was the big thing, and it was a big thing in the sense that this is money that you've already paid tax on. They collected it from your paycheck. They stuck it into the Social Security Trust Fund. You'd already paid tax on it. Now you're getting a benefit. You'd think it'd come back to you without having to pay tax on it until they changed the rules and said, well, if you make too much income from other sources, we'll start taxing some of it. So this is important to keep in mind because if you think about what we're talking about with charitable donations, a charitable donation can lower your income. Well, once you lower your income and you actually are collecting Social Security, it can lower the taxation of your Social Security. So think about it as a game. I wrote an article on this. It's called whack-a-mole. You hit one thing, another thing happens. It's this reaction. So it's a double whammy. If you can lower your income through making charitable donations, you can also lower your Social Security tax, causing the benefit to be quite significant, even if you're in lower tax brackets. So I wanted to go through two examples, and I'm doing this because I was given a really good suggestion to give some examples of things, and I wanted to kind of go through an example of a single person. He looks like Bernie Sanders, but he's not Bernie, over the age of 70 and a half. And I'm going to kind of lay out his tax picture And I'm going to go through an example of what this person did in one case with his charitable donations versus doing it through his IRA. And I'm going to show you the impact. So I'm going to lay out the case really quickly for you, and then we'll decide, well, I'll show you why it's beneficial to think about qualified charitable distributions from your IRA. So I gave him about $20,000 worth of income outside of his IRA and outside of his Social Security. So it's just everything he has outside of those two sources of income. $20,000. He has an IRA where he has a required distribution at the age of 70 and a half. This person has to take money out of his IRA, and he has to take $12,000 out per year, and he does it. Social Security, he receives a check for $20,000, but the government looks at all this income, calculates his provisional income, and says, you know what? You don't make enough for us to tax you at the highest level we possibly can on your Social Security. We're going to only tax 56% of it. $11,000 of this $20,000 is going to get taxed. Okay? So that's the way provisional income worked. I'm not showing you the detail because it doesn't matter. At the end of the day, this income here produced a situation where only about 56% of his Social Security was taxed. Then he has itemized deductions of $11,050. So I added up all those 4 different itemized deductions for him, and it was $11,050. And then he says, you know what, and I should say it's everything but the charitable donations, $11,050. I then had him add $3,000 of charitable donations to the list, and it added up to $14,050 of itemized deductions. All the itemized deductions, including his $3,000 of charitable donations. You following the guy's situation? His tax is $3,313. This situation. Let's switch one thing up. Let's have him not give the charitable donations down here. Let's have him take it out of his required distribution of that $12,000. So all I did is I said, you know what? He'll take 9 of it for himself to spend on what he needs. And he'll give $3,000 of it away out of his IRA. And together, that adds up to 12. And the government says, you've satisfied your required distribution. $12,000. You gave 3 to charity. You took 9 for yourself. $20,000 of Social Security still comes in, but because this $9,000 is lower than what he took for himself before, and this part went to charity, the government doesn't count it as income because it's going to a charity. It doesn't count as income. His overall taxation on Social Security goes down to 44% from 56%. So not only does he not have this income counted as taxable income, but he also has less of his Social Security counted as taxable income. And the end result is he then looks at his itemized deductions, and he added up to $11,050, and he doesn't have any charitable deductions to count. So then he says, you know what? I'm going to do the standard filing of $14,050. That's what it is for this gentleman at age 70 and a half. Magically, the same level of deductions with the donations as it would be without. The standard deduction applies for this person. So he writes down his list of itemized deductions, and there's no charitable deductions listed in it, and the accountant says, totally fine, you're still getting the same $14,050 of standard deduction. His overall tax bill decreases by $666. When you run the numbers, he gets a tax break. And where did he get that tax break? He got it from being able to give the charitable donations out of his IRA, and he got it by having less of his Social Security tax. That's the whack-a-mole, the double whammy. So it's important for you to recognize that if you're over the age of 70 and a half, if you have an IRA, and if you have charitable intent, you should get a checkbook issued, dedicated checkbook from your IRA, from your brokerage firm, and you should use that instead of grabbing your personal checkbook and writing checks. That's if your standard deduction is going to be higher than your itemized deductions. If you're in a situation where your itemized deductions are much, much larger, then this does not matter. because you're going to get a tax break on your charitable deductions anyway. It's for the vast majority, the 90% now who are using standard deductions. This is where it applies. Okay, now I'm going to move on to people who are under the age of 70 and a half. They don't have an IRA to be able to use to write checks because you're not allowed to give charitable donations out of your IRA until you reach the age of 70 and a half. So what are the opportunities for these people? Well, first and foremost, I will have to tell you that I tend to gloss over this. If you've got stocks in your portfolio, in your taxable account, that you've built up this very large gain. So you're like Warren Buffett. You built a company, it's become worth billions, you've got all this unrealized gain. You can give that away because you're giving away a future liability of huge taxes someday. If you sell it, you're donating that appreciated stock to a charity. The charity can sell it and they don't have to pay any tax. So appreciated stock is a really wonderful thing to use as a gifting vehicle. But I really want to focus on what's called a donor-advised fund. A donor-advised fund is a way for you to potentially regain some deductibility of your donations if you're under the age of 70 and a half and if you don't have an IRA. This is a good vehicle. Basically, it allows you as the donor to send money or securities into a donor-advised fund, and these are set up all over the place now. Vanguard, Charles Schwab, Fidelity, they all have a donor-advised fund that you can contribute money to, and then you have the authority, I shouldn't say authority, you have the right to pick charities that you want to have the money go to in the future. You can advise them to give the money to Father Fred or to give it to the library. Has to be a charitable organization, a 501c3, a tax-exempt charitable organization, qualified. The money goes into the donor-advised fund and it gets invested. You don't have control over the investments other than you can choose certain kinds of investments. So you don't get to pick individual stocks, but you can choose mutual funds or an asset allocation that's aggressive or conservative or really conservative. And the money then can grow and grow and grow. It never is going to be your benefit. You're never going to be able to give it to your grandkids. It's gone. It's been donated. What did you get in exchange for the donation? You get to mark it down as a charitable donation in that tax year. So you get to put it on your tax return as a charitable donation. So if you are thinking about giving money away and you're close to the standard deduction with your itemized deductions, this is a way of getting over the hump. You could give away a lot of money all in 1 year, bring your itemized deductions with your charitable donations way above the standard deduction, and then use that big tax break that year and give away the money in the future without getting a tax break. And I'm going to demonstrate for you how this can save you money, this concept of using this envelope, this donor-advised fund as a way of bunching your donations, bunching your charitable intent. So here's a couple under the age of 70 and a half. So they can't use their IRA as a charitable tool. They have to think of another way. Imagine them having income of $95,000 and they listed all their itemized deductions other than their charitable donations, and it was $20,800. And then they added up all their charitable donations that they made out of their regular old checkbook, and it was $4,000. It added up to $24,800 as their overall deductions. So $95,000 minus those deductions, they paid a tax bill of $8,036. Those $4,000 of charitable giving just got them to the level of the standard deduction of $24,800. So now I'm going to describe for you a situation where, so when going back, this $4,000 really didn't give them anything more than they had to begin with because they were going to use the standard deduction, you see. It was a wasted $4,000 donation in terms of tax benefit. You just got them up to the standard deduction level. Whether they did it or not, they were still going to get this tax break. Is that clear? Now imagine the same exact setup, but this time they said, you know what? We've got a pretty good idea that over the next 4 years, we're going to give away 4,000, 4,000, 4,000, 4,000. We have the money in the bank already. Why don't we just put $16,000 inside of a donor-advised fund right now and take the tax break that they're giving us, and then we'll use the donor-advised fund over the next 4 years to just donate where we want to over the next 4 years, or even, frankly, over the next 10 years. There's no time limit. They could do it right off the bat, but likely as they would piece out their donations over the course of time. What did it give them? Same income, the same itemized deductions outside of charitable donations, but then they did 4, 4, 4, 4. They bunched their donations all up into 1 year, and they said, I don't want to give it all to Father Fred this year because I might change my mind. I might have other things in the future I want to give money to. Why don't we put it inside that donor-advised fund, that envelope, and then we'll piece it out to the charities of our choice in the future. You still get the $16,000 donation happening, and now you have much higher deductions at this point, way above the standard deduction that they were going to get regardless. Their overall tax bill dropped by $1,440 for making these extra bunched up charitable donations. So that's the power of a donor-advised fund for people who are under the age of 70 and a half who have charitable intent, and they don't want to waste their charitable deductions from a tax perspective. So I'm going to talk about the Secure Act really quickly, and then we'll just end it with some questions and answers, and I'd be happy to answer as many questions as you have. The Secure Act I referred to in the beginning, where Congress passed it unanimously at the very end of last year. Really quite surprisingly, they lumped it in with a spending bill, which they had to pass to keep the government going. So they just usually throw these kinds of things into the bill, and it has to get passed. So this bill had two major changes. One is the required minimum distribution age that I've referred to throughout this entire talk is 70 and a half for people who were born, who reached 70 and a half sometime before the end of last year. So if you happen to reach 70 and a half back in 2019 at any point in time, you're going to live under the rules that you have to do a required distribution from your IRA forevermore, starting with the year of 70 and a half. But if you were born, if you were not 70 and a half by the end of last year, your new age is 72. So they let people now extend their IRA's life a little bit further, deferring that tax that's going to happen, deferring the required distributions out, a year and a half or 2 years later for some people. That's the change. Now, interestingly, back in the old world before December of last year, 70 and a half was the required minimum distribution age. It also was the qualified charitable distribution donation age from your IRA, remember? They were the same. Now, people who didn't quite reach that age last year, your new age is 72, but guess what? You can still give money out of your IRA once you reach 70 and a half. They didn't take that away from you. They didn't tell you you have to wait to 72. You still can use your IRA as a charitable tool at the age of 70 and a half. Small complication to keep track of, and I think they do it for the benefit of professionals like me so that people are confused all the time and ask questions. I'm pretty sure that's the reason they did that. So that's something I wanted to point out. Number two, when somebody dies, when you die, when we all will die, you pass along your IRA to your beneficiaries. If you pass that IRA along to your spouse, it becomes their IRA, and they live under those rules of 70 and a half or 72. That's the world they live in. They have to do required distributions, and they can stretch it out over their lifetime. When your kid or some non-spousal beneficiary inherits your IRA, it used to be that they could inherit it, but they had to take out money based on their life expectancy. They could stretch it out for their entire life. So you could be a 47-year-old who inherits an IRA like me, and I could stretch it out over my life expectancy, which might be another, let's call it 40, 45 years. Bit by bit by bit, I have to take this money that's never been taxed, and I have to pay a little bit of tax every single year and take money out. What's a pretty great benefit. If I got a Roth IRA that's already been taxed, I can also take a bit of it out without ever paying any tax on it, but I get to stretch that Roth IRA out for the rest of my life. Very, very beneficial. They took this law, they said, no, forget it. 10 years. If you inherit an IRA and you're not a spouse, so you're a non-spousal beneficiary, you've got 10 years to drain that IRA. And that's a pretty big change from some families who really are relatively well-to-do and want to pass along a pot of money in this tax-deferred state. This is going to change their calculation on what they, it's going to change their calculation on saying maybe we should do Roth conversions now, as opposed to giving a kid the IRA and having it stretch out over time. Maybe we should just take the tax hit now to give them the Roth. But this stretch IRA idea was always a conversation that people had with themselves and also with their advisor. That now has shrunken down, that stretch has shrunken down to this 10-year window. You have to take care. Now, there are implications to that. People are going to inherit the money, and I can tell you it's the vast majority of people get an IRA, they inherit an IRA, they're not a spouse, and they cash it out. And I would say they cash it out because they need the money. That may be the vast majority of people. But they also are probably not totally cognizant of the fact that if that's a big enough IRA, it could actually hurt them from a tax perspective to have all that income flow into their tax return that year. So stretching it out was a tax benefit. What you don't want to have people do is say, sit on that IRA for 9 years, and then wake up to the idea, oh my God, I only had 10 years, I got to now drain it in the 10th year. Well, that's not going to be great tax planning. So people who inherit IRAs need to think about, now I've got 10 years to get this distributed to me and pay tax on it. Maybe I need to think about what the best years will be. If you've lost your job and your income is down, what a great year to cash out the IRA when your tax rate's low. You know, I got a great job, I've got capital gains, I've got things that have happened. This is not a good year for me to take out that money out of my IRA. I've got 10 years to play it and play the game. So there's going to be some tax planning that people will have where they're going to decide whether they want to actually take it out now, take it out in bits and pieces, do it in a varied way over the course of 10 years. So it'll give a planning opportunity for people. So with that, I'm going to move into Q&A, and I hope that this was informative.